there are a lot of issues that can arise when it comes to centralized exchange.
Like stealing the client's money.
Exactly. There is no way a DeFi protocol, a decentralized exchange, can bank run. There is no way they can do that because everything is based on smart contracts. Smart contracts have embedded code that basically acts only within the realm of that code. So you can't manipulate it once you deployed it. There are definitely exploits that can happen, but those exploits can be easily mitigated.
Welcome back. My next guest is Alex Yavlikhov. He is the COO of Jumbo Exchange at Jumbo.Exchange. Alex, welcome.
Yeah, thank you. Thank you for having me. Yeah, it's great to be on the show. I actually have seen quite a bit of your show, and I was quite impressed with the questions and the responses. So I'm looking forward. Yeah.
Well, for dinosaurs, we aims to please. What can I say? Alex, let's start with an overview. What is the business of Jumbo.Exchange?
So the business we operate in is Web3. So the space is Web3. It's basically DeFi, decentralized finances. So Jumbo Exchange in general, I can describe it as an exchange. So basically, as you might be familiar with centralized exchanges, there is a kind of mediator between people, and they basically have a kind of control over the assets. When it comes to decentralized exchange, which is Jumbo, which is our project, decentralized exchange basically allows to get rid of the mediator, and people basically have an opportunity to interact with other people, basically peer-to-peer. And this, the whole idea of DeFi is that you have control over your assets. So no one is in the control of your assets. And we at Jumbo is basically trying to encourage people and trying to make the experience of DeFi more so streamlined. So that's the very kind of cursory overview.
Okay, so then in a decentralized exchange, that's kind of the opposite of what Binance and FTX was.
Yeah, that's basically a great way to put it. So in centralized exchange, in like Binance, you don't have, there are a lot of issues that can arise when it comes to centralized exchanges.
Like stealing the client's money.
Exactly. There is no way a DeFi protocol, a decentralized exchange, can bank run. There is no way they can do that because everything is based on smart contracts. Smart contracts have embedded code that basically acts only within the realm of that code. So you can't manipulate it once you deployed it. There are definitely exploits that can happen, but those exploits can be easily mitigated.
Mm-hmm. So when you say smart contracts, are you referring to Ethereum then?
So you have several blockchains, as you might be familiar with. There is Ethereum. Bitcoin is not a blockchain; it's a ledger. Not a ledger. Bitcoin doesn't have its own DeFi because you can't really write smart contracts on Bitcoin. On Ethereum, you can write smart contracts. So on Ethereum, you can build. Yes, there is also Solana. You might know Solana is also a very popular blockchain right now. But we, on the other hand, we are building on near blockchain. So near blockchain, the kind of advantages of near blockchain is several. One of those, I'm comparing again with Ethereum in this case. So when it comes to near blockchain, there is less transaction fees. So on blockchain, there is transaction fees. You pay for the gas. You pay to, for example, transfer assets to one another.
So that's what they call the gas.
So, yeah, that's what they call gas. So you pay the gas, you pay those fees when you want to transfer or in any way interact with a smart contract. You need to pay the fees. You need to pay the fees. When it comes to Ethereum, you pay the fees for example, miners, so that they do their work. Since Ethereum went proof of stake, you don't pay to the miners, you pay to the stakers, those who delegate their tokens in order to keep the network running. So basically, NEAR is delegated proof of stake. It's basically the same as I just described, but the advantage of NEAR is less transaction fees, and the whole experience is more streamlined and it's more seamless because it's built on the kind of backbone of being convenient to users. So that's partially why we have chosen NEAR in our case.
Mm-hmm. Okay, so when you say near blockchain, what is exactly meant by near blockchain?
So blockchain generally can be understood as a ledger. Blockchain contains all of the transactions. Blockchain contains all of the information that goes on within the ecosystem, within this kind of ledger. So every information is written on the blockchain. So everything is contained, everything is transparent. You can basically see through every bit of information that goes on. And when it comes to traditional finances, for example, you can be in the situation when you, for example, don't know where certain assets went. You can't really trace or track those transactions, that transaction. There is no visibility, there is no transparency. And that's where the blockchain shines. It basically allows you to view transparently, publicly, and it's accessible to all. And you can view all of the information written on it, all the transactions stored. So that's the whole idea of blockchain and why people are raving about blockchain,
Yeah. Okay, so then in terms of KYC and AML provisions under US law, does the Jumbo Exchange make that possible?
So right now, KYC and AML in general is kind of gray area in DeFi, simply because you can just cram the typical AML into DeFi. It just doesn't work like that. You can do that. There are a couple of workarounds in terms of KYC. So KYC is know your customer. You basically upload documents, ID, and so on to verify yourself. When it comes to KYC, you basically need to verify and check the transactions. Know your transaction instead of know your customer. Know your transaction is basically you check and vet every transaction within the blockchain on the risk score and the risk category. So in case of Jumbo Exchange, we're trying to make compliance more so on the KYC side. So we have KYC approach. So for example, when a malicious user or actor tries to interact with our exchange, they're trying to launder assets that are not necessarily clean. They might not be able to interact with our exchange because our system, our built-in system of KYC and AML, disallowed him or her to basically interact with our exchange. We are not trying to de-anonymize a user himself or herself, because it would mean it would basically mean that we are impinging on the blockchain idea. So we are not doing that. We know that it can cause backlash. So the idea we kind of came up with is KYC.
Mm-hmm. So then the transactors on your exchange are basically writing a smart contract according to your protocol and connecting their offline wallets to fulfill the fulfillment of the contract?
So how it works on DEXs usually, decentralized exchanges. You connect a wallet. When you connected the wallet, you can see on the user interface what kind of liquidity pools you have. Liquidity pool is basically assets that are contained within this pool. So you have, for example, a pair of USD to Ethereum, for example. You need to have a certain amount of USD and a certain amount of Ethereum. The great thing about, again, decentralized exchanges is that those assets in that pool cannot be withdrawn and cannot be tampered with without basically in any case. So that's a great thing about DeFi. So you connected your wallet to the decentralized exchange, and you can basically do the same as you do on centralized exchanges. But the kind of issue with the DEXs right now is they're kind of unwieldy. It's hard to, user experience is basically not great. So what we are trying to rectify in our case is to make it more so approachable and more so convenient to users, because the main qualm people have about DeFi is that it's just not convenient.
Mm-hmm. So I guess then the user of the Jumbo Exchange has to have a high degree in the confidence of the security between the platform itself and their wallet, because I could see where that must be a weakness potentially for a bad actor to exploit that connection and potentially access a wallet improperly.
So when it comes to wallets, everything that is related to wallets, it's at the user's discretion. So we can't tamper with user wallets in any way. They just connect their wallet to our exchange. There is a bit of trust that needs to be put in place. For example, when you connect your wallet, you expose yourself to certain risks. That is, for example, how people get caught into phishing exploits. They connect their wallet and their assets just gone in a minute. So there's definitely a certain trust you need to put when you connect to a certain decentralized application. So that's a very great point that you brought up. That you definitely need to build that trust throughout your kind of cycle. So the great thing about that since you connected once and you didn't get scammed on DeFi, you know that if you connect the second time, you won't be scammed also, because I can just on the fly change the smart contract and exploit you the next time, for example. So that's a great thing about DeFi.
Mm-hmm. Okay. So do you have clients in the United States who are American citizens?
According to our demographics, the majority of our users are in Vietnam, in Asia. In couple of some of the cluster of our users is also in Europe, Western Europe. We have also a lot of people from the Eastern Europe, since Russia is battling a lot of sanctions, and people are trying to tap into DeFi more so because of the restrictions. So they are kind of also more so engaged into DeFi. Eastern Europe and Asia is basically the majority of our user base right now. When it comes to the US, I think it's basically, I would say, somewhere at the bottom of the list.
Right. Okay. So then I mean, my audience is 50% American. So as an American, can they sign up to your system and use it without worrying about being offside with regulators?
So when it comes to the US regulations in regards to crypto, the only enforced regulation, as far as I know, is taxes. So you are taxed on the crypto assets that you own, so you can just avoid taxes. When it comes to interacting with DeFi and with decentralized applications, there are no restrictions. So anyone can basically do what they want. And that's, again, a great thing about the whole blockchain space, that anyone is basically can interact with it without any restrictions and without any demographic or any other restrictions. Yeah.
I see. So it's incumbent upon the user then of your system to comply with tax disclosure rules and everything within their respective countries.
Yeah, exactly. The majority of DeFi won't be held responsible when it comes to any legal scrutiny, for example. So yeah.
Okay, so you on your website it discloses that you've got you've done $745 million in volume, 20,000 plus unique wallets attached to the system, and total value locked of 19.5 million. What is meant by total value locked?
So TVL, or total value locked, is basically when people can stake some of their assets. Staking means just like depositing assets. They deposit those assets and they can get a return on those assets that they stake because they provide liquidity to the pool. The ones that we discussed that are on the decentralized exchanges. People provide liquidity to the pool. They provide other people a way to trade, and they get in return the commission from all of the trades, or all of the fees that they trade.
They get the gas.
Yeah, exactly.
Okay, so then finally, tell me about the cost structure. So let's say I've got $100,000 in, let's say, Tether, and I want to buy some Solana. And I go to your site and I see, okay, there's a sufficient volume of Solana that I want to buy. And so I hook up my wallet. I imagine that the tools to execute the smart contract with the vendors or the holders of the Solana are on your site. Is that part of what the service is then?
So yeah, those who are on the decentralized exchange, they provide the liquidity to the pool. So you are correct, yeah.
Okay, so how much total fees would the transaction cost for me to swap $100,000 in Tether for $100,000 worth of Solana?
So I think on near blockchain, those fees would be negligent. So around maybe, again, that's at the top of my head, the recent transactions that I did, I think it was around 2 cents.
2 cents on $100,000?
Yeah.
Wow. So that's interesting. That's very attractive then, because I've done a few crypto transactions on centralized exchanges, and the cumulative fees are always 2, 3, 4%. And to me, that's you certainly can't day trade. You can't scalp trade assets when they're taking 2 to 3% for money in and money out. So that's very attractive then. So it strikes me then like how that's not a lot of money for you to make. So for the platform to make, if every time $100,000 in value goes through, you only get 2 cents. So how does Jumbo make money?
So the first one is the fact that we get a lot of transactions. So that kind of accumulates, especially daily, especially when it comes to months and weeks. On the top of that, we also recently fundraised a lot of assets. So we can manage our expenses in the way that we can promote our services, and therefore we can also attract a lot more users, which will in turn increase our output and our revenue. When it comes to the DeFi and earning from commissions, it can become a little bit more difficult, especially when the market is in slump. It's definitely more so difficult to do so. However, when it comes to the bull market, the fees accumulate very fast, and you get basically a lot. You get a lot of money from the trades.
Okay, great. Alex, we're going to leave it there for now. That's, I could talk to you all day about this, but this is a long interview already by our normal standards. So I appreciate your time, and it's a very fascinating space. I am more so attracted to decentralized exchanges as the obvious solution to the FTXs of the world. So I think that's where the future is. So I'm going to have you back in a relatively decent amount of time. And thanks for joining me today.
Yeah, thank you for having me. Yeah.